welcome. You're watching this fresh and new edition of BTS Behind the Scenes with me, Sakshi Batra on Business Today TV. And this is a show where we share a sneak peek into the latest issue of the Business Today magazine. And joining in to share what can we really expect this time around is Anand Adhikari with me, Managing Editor, Business Today magazine. Also joining in is Alokesh Bhattacharya, Managing Editor of Business Today magazine. And also joining in is Ashish Rukhayar. He's the Senior Associate Editor of the Business Today magazine. Welcome, gentlemen, and thank you so much for taking the time out. And as we all know, is a special issue and covers India's best banks, which is the 27th Business Today KPMG survey of India's best banks. And just to give a glimpse to all our viewers, that's how the cover really looks like. So, Anand, let me kickstart with you first. Talk to us about the whole study that BT KPMG survey is all about when you find out the best banks, and what is the methodology that you've been looking at in selecting these ranks as well. And how does Business Today really select the country's best banks and fintechs?
So thank you, Sakshi. This is the most well-respected, study in the market, and we have been doing this study for the last 27 years. And just to give you a brief background, BT started in 1992, that post reform period, and within 3 years of its launch, we started this best bank study. And initially, we had CRISIL, as a partner. For most part of the years, if I see, more than 2 decades, we had KPMG, as a partner. So this study is divided into 2 parts. One is the quantitative part and second is the qualitative part. Now, within quantitative, you see, we have growth, we have size, and we have strength as parameter, broadly 3. And within these 3 parameters, we have 35 sub-parameters. So if you look at growth, we have like growth in deposit, growth in advances. If you look at size, we have balance sheet size, loan book size, deposit size, and if you see the strength, then we have, ROCE, NIM, net interest margins, capital adequacy, NPAs. So based on these 35 sub-parameter, KPMG, they decide the winner. So at the end of the day, we have like 5 bank winners where we have large, mid, small financial bank, and also a foreign bank. The second element of this study, Sakshi, is the qualitative part, where we bring in the jury element. So this time, we had a very high-profile jury. We had Mr. Kamath, Mr. AP Hota from NPCI. We had Mr. Puruwar. We had Mr. Alice Vaidyan, former chairperson, GIC. And we also had Dun & Bradstreet MD CEO Avinash Gupta. So there's a 5-member jury. So under the jury, we have Bank of the Year, and then we have some category awards, and then the fintechs, best fintech in value-added services and best fintech in payments and all. So that's how this entire study is divided into 2 parts, and we decide the winners.
Absolutely. So which bank has emerged as the best bank this year, and any more surprises that you found in the study today?
So Sakshi, 2 or 3 big surprises. I mean, if you ask me, the Bank of the Year, if you see the study, SDFC emerged as the best bank in terms of the quantitative part. When we put the entire study before the jury, because they look at the qualitative parts also, and jury decided ICICI Bank. Because if you see ICICI, Sandeep Baxi there has in a way stabilized the shape. Now they're doing more retail than corporate, and if you see their corporate portfolio is more high-rated corporates. So when the discussion started, I think jury was more, discussions were more tilted towards the ICICI Bank. A second big surprise, if you ask me, which I saw in the mid-sized bank category. We had this Bank of Maharashtra, which is a very Maharashtra-dominated bank, and it was under PCA, under the RBI's prompt corrective action. They had very high NPA 4-5 years back, and they emerged as a winner. And when we met the top management, and one initiative which I thought I must tell you, it's a Maharashtra-dominated bank, but they decided to have a 1 branch every district. And the kind of results they have got with this, today they have the highest CASA in the industry. It is 56%. So again, I mean, that was a big surprise, in the study. Third, I think, this State Bank of India, jury decided to have a special, award as a consistent performer, and SBI emerged there as a winner. So a couple of surprises there, and I want viewers to read the magazine. There's a lot there.
Absolutely, Anand, you're right over there. And, we've seen that the Indian banking sector has actually staged a dramatic turnaround from the previous couple of years to a stellar performance from PSU banks also in 2022, which has surprised many. But going forward, is it going to be a smooth ride on the upside, or are there going to be some more challenges that the banking sector may face?
Sure. So I think there are a couple of challenges which I see. One, if you see the loan growth, I mean, suddenly we are seeing a very high loan growth. The question is, I mean, is it sustainable? Given the global recession, given the slowdown which we are seeing next year, people are targeting 5 to 6% GDP. So sustainability of this loan growth is a big challenge going forward. Number two, if I see the deposit side, credit is growing at 17% plus. Deposit is going around 9% plus. So big challenges on the resource mobilization, and we'll see some, competition, some, rate war, on the deposit side. Third, if I see, the most of the growth is coming on the retail side, and within retail is the unsecured segment, especially credit card and personal loan, and many banks, if you see their balance sheet, the unsecured part, especially on the retail, if you see, it has gone maybe 10 to 20%, and that's a big risk. Again, MSME is another segment which is growing. If you see, banks' balance sheet, it is growing at like 30-40% year after year. And there again, I see, some risk which will build up. Though everybody talks about is, this GST and a lot of data is digitalized and all, but I did see some risk on the MSME side. And finally, the technology, the way we are seeing disruption in the market. I mean, today, if you see the payment side, we have Google and the PhonePe of the world, ruling almost like 90% market share. So I see a big, threat to traditional bank in some of their segment, the fintechs and the technology companies.
Absolutely. And we've been looking around all across business today, and also at Davos, the conversations regarding, and also at our, banking summit also, the large, emerging point was how there should be a collaborative action if both fintechs and banks, traditional banks, need to succeed. There need to be more collaboration to be able to capture the young minds and the Gen Z per se too. So that's been the emerging talk point. And of course, the banking space has been a power engine of the economic growth, and we do hope that they're able to overcome these challenges as well going forward. But now, of course, the big news point which everybody is eyeing, especially the stock markets, is the countdown to the union budget, which has begun now. So Alokesh, let me come back to you now and to understand, this is the last full budget before the next general election. So there's a wide discussion about whether this could be a big populist budget that, one can expect. What are your thoughts here?
We expected that last time, it didn't happen.
Yes.
This is the second term of the government.
Yeah.
So Sakshi, basically what happens here is that this government is a very, we are not politically affiliated, neither are we going to discuss politics here, but they're in a comfortable position, right? And even Nirmala Sitharaman, the finance minister, had gone on record saying publicly that we will continue to do what we have done the previous few years. We are not going to change anything and make radical changes. So you can expect more or less the same kind of approach, in the sense that the government will focus a lot. We expect the government to focus a lot on infrastructure capex, right? So in last year's budget, there was almost a 35% jump in infrastructure capex spent by the government. So that is, most experts have told me that they expect that to continue. Yeah, and that is a good thing also, because infrastructure spending means there's a lot of construction work going on. And construction is the fastest way to give jobs to people, right? You start a project and you have to employ hundreds of people, thousands of people to build roads and build bridges and things like that. So people get money in their hands, and it sort of keeps the growth momentum going. So that can definitely be expected. And while we can't expect too many SOPs, but some will surely be there. I'm hoping that they'll give huge income tax cuts and all of us can go home with more money, but that is unlikely to happen.
We can continue to wish that, but this finance minister doesn't seem to listen.
Absolutely. We have, all of us have been wishing that for the past so many years, but not much has moved there. So
absolutely,
absolutely.
I think Sakshi, the big challenge, if you see the nominal growth, I mean, next year, the nominal growth is going to be 10-11%, and then entire fiscal space is shrinking. So They're all hoping that something should be done on the consumption side, like what Anukesh said on the taxes side.
Absolutely.
That will fuel consumption. But government has a lot of limitation because they have to now go on that glide path of reducing fiscal deficit
and the current account deficit. Yes, absolutely. Because, this budget comes at the backdrop of skyrocketing inflation on the one hand, rising interest rates. You see the stretched finances and the slowing exports, looking at the global slowdown concerns ahead. So there is a challenging global environment that the finance minister has to keep in mind before presenting this budget. So, amid that, what could be the expectations that the industries can have ahead of this budget too?
So you see, what's going to happen is while you're right, and Anand is absolutely right, that nominal budget is going to rise. But if you look at the real, nominal GDP, but if you look at the real GDP, even the real GDP is actually shrinking, right? The GDP growth, not the GDP. So, for example, we had in 15-16, we had a sufficiently high growth of 8.3%. Since then, it came down to 3.7% thereabouts before COVID. During COVID, of course, we had that huge contraction, and then we came back to 8.7% in 22. Now, what's happening is you came back to 8.7%, but that was partly fed by the, the return of demand, of pent-up demand, which was there during COVID, right? And partly because of the base effect. Because the whole thing went down so much in the COVID year, that's why the real GDP growth in the next fiscal looked better. But now we are back to, that downward kind of curve, right? So this fiscal, anywhere between 6.5 to 7% is what everybody is expecting. Next fiscal is like 5 to 6% real GDP growth people are expecting. And I think Raghuram Rajan told us in Davos that will be less than 5%, right? And Nomura has predicted 5.1%. Others have predicted different numbers. And the most optimistic numbers are 6 and 6.1%. GDP, which is actually, if you look at the global thing, is very good. But the point is that it's still going down, which is not so good, right? And you're right in the sense that the fiscal deficit needs to be controlled. Two, three ways that the government can be expected to control the fiscal deficit. One is that just like last year, this year also the government is expected to raise a lot of extra money in taxes. It's about 3.5 lakh crores of extra tax money is coming into the government, which is what the government has told publicly. Now that money, ultimately, where is that money going to be used is the key, right? Because you can use that to cut down your deficit. You can use that to spend more, on the infra projects and other spaces. But the bigger problem in all this, calculations is that most of our GDP growth, because of the infra push, is being pushed through government expenditure. It is not coming through organic industry demand.
Yes.
Right? The real demand of a country and economic growth is private consumption and private investments. And private investments are not picking up at all. 85 to 90% of the capex spend that is happening in infra is coming from the government. And that needs to be changed. So some experts have given some views. So one of the things that could be done possibly is to have a much better credit guarantee scheme. The credit guarantee scheme in our country, which is basically led by the IIFCL, is very low. It's in the thousands of crores. Whereas if you look at the national infrastructure pipeline, that's a 100 lakh crore kind of gargantuan thing, right? Thousands of crores, that kind of credit guarantee is not going to get you private companies, interested to invest in infrastructure. Plus, you will remember from history that infrastructure investments have had very bad experiences for private companies. And several private companies have exited midway through multiple projects because of regulatory challenges, because the projects are going on and on, delayed, the budgets are climbing. So the experience is not good. So those things need to be addressed. And we are hoping, that the minister will address that. Because unless you can get private investment into the budget, into the infrastructure space, the growth is not going to be sustainable. It will keep coming down.
Absolutely. Lots of things that the government really looks like they have to look at in this upcoming budget. A tightrope walk again this time around when it comes to managing and being on the fiscally prudent path, as well as looking at right ahead of elections. How do you really appeal to a larger vote bank right there? But we'll see how the finance minister does that in just a few days' time. But let's move away from the macros to a little bit of how stock markets are really shaping up. Ashish has done a story story on how the latest round of DRHPs is actually coming under the scanner of the capital market regulator, SEBI. Most of the IPO-bound companies have actually an industry overview section in which the third-party industry report findings are also included. So could you, Ashish, tell us what exactly are the concerns right there? We've seen a whole lot of companies being sent back all the DRHP papers, including OYO, and they're going to be coming out with their updates perhaps in next month. And the valuation concerns still, quite, surfacing right there. Your thoughts?
Hi, Sakshi. Thanks for having me on the show. Let me quickly give you the context of the story. So all the companies that want to list on the stock markets have to file a document with SEBI called Draft Red Herring Prospectus, or DRHPs. Sure. Now, all these DRHPs have a section called Industry Overview, in which there is a lot of data, statistics, estimates, forecasts related to the sector in which the company is operating, and also related to the company. But the company themselves can't do these kind of come out with these kind of estimates and forecasts. So they give this work to these third-party companies that do this kind of research and give the reports or the findings to these companies. Now, more importantly, all these creating this report, this work is commissioned by the IPO bond company itself. So basically, the company that wants to go public pays these research houses to come to create these reports. And so obviously, these reports typically wouldn't have any kind of adverse findings or say bearish estimates regarding the company or the sectors. If you look at some of the recent IPOs or the DRHPs or some of the IPOs, especially of these startups, they would say that, say for instance, today the market size is X. In 5 years, it would be 5X or 6X, and this company is like the category leader. So there's scope for exponential growth. Now, the DRHP is a very important document. All the investors make their investment decision based on what is mentioned in the DRHPs. So obviously, if the document has these kind of projections or estimates, it does lead to a lot of investors investing in the stock. And if you have seen some of this post-listing performance of most of the recent listings, they all have been currently they're all significantly lower than their issue price. So obviously, sure, that raises a big question, like if there's so much potential, if there's so much scope for exponential growth, then why are the stock prices so, I mean, why have they performed not according to the potential? Obviously, I mean, the stock price performance is prone to a lot of external factors as such. And the more interesting part is this, while the DRHPs have a lot of findings of these reports, they also include disclaimers as well. They will say that, okay, fine, though we have to the best of our efforts, we have done all these analysis, we have come out with these projections.
Yeah, I would say stock market investment is a risky proposition. So always consult your before investing.
Yes, that's the disclaimer coming in from our managing editor for all our viewers who are watching the show as well. So many thanks to all of you, gentlemen. It's been a very insightful discussion that we've had, and I'm sure that this issue promises to be an even more insightful one. So please go ahead and grab your copies. This copy is already out on the stands, and do let us know on the comments below as to how do you really find this discussion. Anything else that you would want to hear from us, from the entire Business Today magazine team as well. Many thanks for joining in, and it's been a pleasure having you with us.